All right, let's dive into something that's on every serious investor's radar right now: US long-term bonds. After all those aggressive interest rate hikes, everyone is waiting for the big pivot. And today, we're going to break down why these bonds are so much more than just a boring interest payment. They're actually a super powerful tool for navigating exactly this kind of economic shift. And that really brings us to the million-dollar question, doesn't it? With all the headlines about inflation, rates, and maybe even a slowdown, you gotta ask yourself, is your money ready for what comes next? Are you actually positioned for the turn? Well, a big part of the answer lies in understanding the market's ultimate safe harbor. We're going to look at why, when things get choppy, some of the smartest money on the planet flows into one specific place to weather the storm. It's a really simple but powerful concept. When the markets get shaky, people don't want risk. They want safety. And for the entire global financial system, the absolute gold standard for safety is debt that's backed by the US government. They're basically seen as the safest asset in the world. This leads to a phrase you'll hear thrown around all the time: risk-off sentiment. Think of it like a global financial reflex. Some bad news hits, maybe a recession fear, a bank crisis, and boom, investors instinctively sell their riskier stuff, like stocks, and they pile into the safety of US bonds. This global flight to quality is a massive driver of their value. Okay, but here's where it gets really fascinating. This isn't just about hiding out and being safe. It's about the powerful way these bonds can actually generate some serious returns. And we can understand it all with a simple seesaw analogy. This right here, this is the absolute core principle. You have to get this. It's an inverse relationship. Just imagine interest rates are on one side of a seesaw, and the prices of bonds that already exist are on the other. When one goes down, the other has to go up. So if you're holding a bond and the Fed starts cutting rates, the value of that bond you're holding goes up. So if the bond price is one side of the seesaw, what determines how much it moves? That's where this word, duration, comes in. It's basically a measure of leverage. The longer the bond's term, we're talking 20, 30 years, the higher its duration and the more dramatically its price is going to swing when rates change. It's like having a much, much longer plank on your side of the seesaw. And check this out. Here's that principle in action. The difference is just stark. A 1% drop in interest rates, it'll barely nudge the price of a short-term bill. But for a 20-year bond with all that high duration, whoa, the price increase can be absolutely massive. This sensitivity is exactly what sophisticated investors are betting on when they think rate cuts are coming. And this is the crucial point, so I'm going to say it again. For a lot of people buying long-term bonds, that small, steady interest payment, that's just a nice little bonus. The real prize, the reason they're in the trade, is the potential for the bond's price to shoot up. That's what we call capital gains. They're betting on the price, not the coupon. Now, beyond just making money, these bonds play this incredibly important defensive role. Let's look at how they can act as the anchor for your entire investment portfolio, especially when the waters get rough. This is the magic of diversification, right? Negative correlation just means that two things tend to move in opposite directions. So during those risk-off periods we were talking about, when the stock market is tanking, that same flight to safety we mentioned often pushes the prices of these long-term bonds higher. One zigs while the other one zags. So let's make this real. Imagine your stocks take a nasty 15% hit. Ouch, that's painful. But if you also own long-term bonds and they happen to gain 10% in that same sell-off, well, your overall portfolio loss gets cushioned. It's down to just 5%. The bonds literally act as a shock absorber. And one source put it perfectly, calling it the anchor of a financial portfolio in a stormy market. I mean, that really says it all, doesn't it? Of course, none of this is a magic trick that works on autopilot. Timing is absolutely crucial, and there are very real risks you need to know about. So let's get practical and talk about the ideal conditions for this trade and the traps you need to watch out for. So what's the perfect storm for a long-term bond rally? Well, it's really this three-part setup, and it might sound a little familiar. First, you need inflation to be under control, so the central bank has room to breathe. Second, you see economic growth start to slow down, which is usually what makes them want to cut rates. And finally, the central bank itself starts talking about it, signaling that cuts are on the table. When those three things line up, that's the classic green light. But, and this is a big but, we have to be balanced here. While US bonds have basically zero risk of default, I mean, the government isn't going to fail to pay you back, that does not mean they are risk-free. The risk isn't about getting your money back, it's about what that money will be worth when you do. And here are the two big ones you gotta watch. Interest rate risk is just the seesaw working against you. If rates go up when you thought they'd go down, that high duration we talked about means your bond's price will fall, and fall sharply. And inflation risk is what causes that. If inflation stays sticky and high, it might force the central bank's hand, making them keep rates high or even raise them again, which is pretty much the worst-case scenario for these bonds. So let's bring all of this together. We've seen how these bonds can be a defensive shield and an offensive weapon. But how should we really think about their role in the grand scheme of things? Ultimately, it just comes down to their two key roles. Defensively, they are your portfolio's anchor, that hedge against the stock market going south. But offensively, if you get the timing right on the economic cycle, they offer a chance for major profits as interest rates fall. They are one of the very few assets that can play both roles so well. And that really leads us to our final question, the one for you to think about. As this economic cycle turns, how do you see long-term bonds fitting into your own strategy? Are you looking for that safe harbor to play a little defense? Or are you getting ready to play offense and really capitalize on the turn? It's a huge question for every investor to be asking right now. Thanks for tuning in.